real estate hills that I'm willing to die on. But I want to share them because I think it's going to be helpful for a lot of the newer investors out there. Let's ruffle some feathers. Investment advice as it relates to buy and hold real estate investing, rental real estate investing, multifamily investing, etc. Investing advice that falls under those categories from over 90% of residential real estate agents is totally worthless. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. In this episode, I'm going to be talking about 5 real estate hills that I'm willing to die on. Another way that I could have titled this episode is 5 real estate takes I have that I feel really strongly about. Some of them are going to be probably controversial to some of the listeners because they are maybe in defiance of how they started their real estate careers or started their real estate businesses. But I want to share them because I think it's going to be helpful for a lot of the newer investors out there. Now, before we get into this episode, I want to talk about the New Hampshire Multifamily Fund 3. We are in the process of raising our second round of funding, our second tranche, which closes on October 1st. All investors who invest before that date are receiving a incentivized preferred return. We've already raised over $1.5 million for this vehicle, and we're raising another $1 million plus in this round of funding to pursue all of the other deals that we have sourced in New Hampshire here. This vehicle is an opportunity for passive investors to ride shotgun and basically invest into all of the deals that we source direct to seller through everything that we do from a direct to seller marketing and prospecting standpoint. And for those investors who are interested in the New Hampshire market, who want to invest in great deals that are run by a vertically integrated team, it's going to be a great vehicle for you. And it's become really our flagship offering as it relates to what we are taking out in the Aligned Real Estate Partners business to our investor base. Now, with that being said, let's get to these 5 real estate hills, 5 real estate takes, hills that I'm willing to die on. Number 1, when you are starting out, and this is specific to multifamily investing, you need to work with a property manager, especially one that is good and willing to manage construction. All of the biggest mistakes I made when I got into real estate were construction related or property management related. Bought great deals, put them together correctly. But when I went to hire the electricians and the plumbers and the GCs to renovate the units, I was overpaying. I was getting ripped off. I wasn't managing the work correctly. And those are really costly mistakes when you get started because that's cash that's coming right out of your pocket. You know, even if you have a loan where they're lending on construction or what have you, and you're drawing down on your loan or something like that. Again, those are dollars that need to be spent extremely wisely because once you start going over budget, even if you do have lending available, money's getting sucked out of your own bank account, right? Or your company's bank account very quickly. And that can really strain your ability to continue pursuing new deals, or it can ruin the deals that you're actually doing that you're going over budget on because it's pulling all of the investable cash out of your account, right? Or a good chunk, whatever the amount may be. Now, what happens when you work with a qualified PM is that they have all of their systems and processes around managing construction, managing vendors, etc. Not to mention that they have a list of all of these vendors and GCs that they've probably vetted at a level that you never would as somebody who's hiring it and managing it yourself. And they have the contracts, the payment schedules, the expectations set with these folks that allows them to much more diligently and effectively manage this process. Now, some of you may be like, okay, well, I didn't have that concern. Okay, that's great. Or I didn't have that issue. That's great. That said, it increases the likelihood that something is going to go wrong early when you are managing folks that you don't have extensive relationships with and that you haven't really had the chance to vet to the same level that a property management company that manages hundreds and hundreds of units or thousands of units has. The other piece of this is on the property management side. When you work with a PM, they're going to know exactly what the market rent is for your units, assuming that they are qualified and a competent PM, right? This is all assuming that we're working with a good PM, not a crappy one, right? Obviously, that's a totally different discussion. But if you're working with a good PM, they're likely going to have managed a bunch of real estate around where your property is. They probably have a good sense of what the tenant demand is for this type of unit. They probably have a good sense of how to price it. And it's likely they have a really good screening process behind the scenes as well, maybe above and beyond what your screening process would look like with your rinky-dink property management software or however you're actually managing the building. So when you're starting out, yes, it costs money to bring on a PM, and that might be money that you really want to save. But what you're doing is you're protecting your downside in such a way by increasing the floor of how the deal can perform, by giving someone who's relatively competent the keys to running it and then do your thing where you diligently oversee the deal and keep an eye on them. Hill number two is that if you're an accredited investor, you should just straight up not be investing passively in real estate. Again, this is going to be controversial. A lot of people out there do 506B syndications where they raise money from non-accredited investors. In my opinion, until you have what the SEC defines as what qualifies for an accredited or becoming an accredited investor, which, $1 million net worth, you're making 200 grand a year personally, 300 grand a year if you're married, et cetera, et cetera. There's a few other ways that you can qualify. You probably shouldn't be investing passively in other people's deals because that's capital that you need to focus on multiplying in your own world before you go and give control of it to somebody else. Even if you're investing small chunks, call it 25K, let's say you're investing in a deal with a low minimum and you're not accredited and you're at $900,000 net worth, it's like, okay, maybe you can make that case that that's okay. But even still, you should probably be more focused on how do I earn the highest and best returns with that 25K and probably exchange a little bit of time for increased returns, which might be learning how to actively invest in real estate, which might be investing in yourself, your own education, so that you can increase your earning potential so that you can actually earn more. So generally speaking, in my opinion, it doesn't really make sense for investors to be investing passively until they become accredited. And I have been someone who's done 506B deals in the past and raised from unaccredited investors. And I do think that there are exceptions to every rule. But broadly speaking, I just don't think it makes as much sense for those folks until they hit that level of accreditation to where they can start to give control of their dollars to other folks. Hill number three. And again, let's ruffle some feathers. Investment advice as it relates to buy and hold real estate investing, rental real estate investing, multifamily investing, etc. Investing advice that falls under those categories from over 90% of residential real estate agents is totally worthless. I know I got a bunch of residential agents that listen to this podcast. Because you are folks who listen to this podcast, especially if you have for a long time, you probably put yourself in that 10%. But the sheer volume of gross incompetence that I see on Instagram, on Facebook, at meetups, whatever, when people are talking about the deal, well, I should say not people, but when residential agents are talking about deals that they're marketing, that they have as a listing, when they're talking about deals that they've bought, when they're talking about, just case studies on deals that a client has bought or whatever, and they're talking about cash flow without including vacancy, without including repairs and maintenance. They're just taking rental revenue minus PITI equals cash flow. My client's earning a 20% cash on cash return. So much of that is absolute garbage, worthless crap. So if you're a new investor who's listening to this podcast and you want to go buy a rental property and you're working with a residential agent, somebody who's not specializing in rental property investing or who does not personally own a number of rental properties themselves, and who, again, that doesn't even oftentimes give you enough clarity as it relates to how to actually communicate cash flow, how to think about rental property investing, how to, price your units, vacancy, the true cost of owning rental property, etc. You should be taking all of their advice with a grain of salt and seeking out information from folks who are literally property managers, full-time multifamily investors, full-time rental property investors, etc., who really do understand what a P&L looks like for a rental property or for a multifamily property. Hill number four, your first deal should be simple. And by simple, let's define that. Maybe a light value add, maybe a stabilized deal, etc. Even if that means you won't make a bunch of money on it. The inverse of this would be your first deal is a big redevelopment or a massive renovation project or something with a lot of meat on it. Because again, as we kind of talked about in, real estate hill number one that I'm dying on, where when you are early and you're working with contractors and you are working with subs, even if you hire the management company to kind of manage that for you and to be your first line of defense there, it still increases the likelihood that something's going to go wrong when you buy a deal with a lot of moving parts that requires a lot of CapEx. The biggest thing that you need to focus on your first, second, third deal, but really your first deal is, I can't lose money. I can't get knocked out of the game before I even gain any traction, because the amounts of things that you learn on that first deal are absolutely immense. And you just want to minimize the scope of how you can screw up, frankly speaking. So you're better off buying a deal that like, yeah, maybe the units are a little dated and, it could use a new heating system or whatever, but it's in a decent area. And when people leave, like, yeah, I'll do the flooring and the paint, but that's pretty straightforward. And then I'll rent it to a new tenant. And it's pretty straightforward. I can wrap my mind around it. There's not a ton of moving parts here versus I'm buying this really banged up deal occupied by tenants who aren't paying in units that are destroyed with siding and a roof that suck and it's in a bad area. Like so much can go wrong there. And again, the likelihood that you just get whacked before you even have a chance to get rolling is huge. And you want to avoid that. Real estate hill number 5 that I'm dying on. This is probably the most controversial out of all of these, is that you shouldn't work with partners or investors when you start out. That makes it a lot harder to start out. And I will be the first to say that I am hypocritical in the sense that, or I'm being hypocritical with that statement in the sense that when you are first starting out, and if you have a hard time finding a deal, or I should say funding a deal or putting a deal together, that you should take that deal to somebody else and partner on it. I do say that a lot, but the nuance there is that should be reserved for like, after you've done your literal very first deal, which should, I mean, it could just be something as simple as just, I'm buying a condo at a cheap price to rent out, or I am buying a duplex that I'm renting out that is very straightforward to manage. There's not a lot of moving parts, etc. What you want to be careful that you don't do is partner with somebody just because you think you should, and because you think you need to, and because you're scared of doing it alone, and because it would be more fun if you did it with somebody else. These are all reasons why I think a lot of people partner with folks. The amount of people I know who just partner with their friend to buy this thing, or their brother, or their dad, or their whoever, and then they realize that they have completely overlapping skill sets. They have different objectives over how they want to actually approach the business. One might want to scale faster and use more debt. The other one might not want to. One wants to be there working on the property themselves instead of hiring professional help. One of them might want to self-manage. The other one might want to hire a property management company. There's so many different ways that partners can disagree. And then the same thing with investors. Like when you do a deal with investors, the stress is amplified so significantly and your margin for error basically disappears because you're losing other people's money, and that is an entirely different ballgame than losing your own, because you can always go make your own money back. Yeah, you can make your investors' money back, but like they're probably not going to trust you the chance to do it if you lose it in the first place. So it's my opinion that investors should just do a deal by themselves when they start. Again, you learn so much with the first couple, that if you want to go and partner with someone and you have somebody in your network who really does have a true, clear, complementary skill set, whether that's a personal friend, a coworker, a family member, or just somebody that you meet at a meetup, they are a true operations guy, you are a true deals guy, great. Maybe that does work. But at the end of the day, you should like just give it a second before you jump into something like that. And the one exception I will say here is like if you are literally starting out and you do not have a single dollar to your name and there's really no roadmap into getting a dollar to your name in terms of actually being able to do that first deal, okay, then maybe you go and take that deal that you might find through all of your hustle and hard work as it relates to cold calling and cold emailing, maybe sending out some mailers or whatever, and then you take it to somebody and you partner on it. But in that sense, you are defining that you have a complementary skill set because you're bringing the deal to somebody who's going to operate it. So again, that would be the only exception to this, but I think that's the exception and not the norm for most folks that are getting into real estate investing. So to recap, the 5 real estate hills that I'm willing to die on here and some of these controversial takes that I want to unleash on the podcast feed. Number 1, when you're starting out, you need to work with a PM, especially one that's good at managing construction. Number 2, if you're not an accredited investor, you just probably shouldn't be investing passively. Number 3, investing advice from 90% of residential agents is totally worthless. Number 4, your first deal should be a simple one, a light value add, minimal construction, etc., decent neighborhood, even if it means that you won't make a bunch on it. And number 5, you shouldn't work with partners or investors when you start out. Little asterisk, unless you absolutely have no choice but to do so. Appreciate you all listening. Hopefully this was something that is insightful, maybe helpful for some of you guys who are out there listening. We've got a couple of great episodes coming up on the podcast feed the next 2 weeks with 2 great investors, 2 great guest episodes that I'm really excited to release. So stay tuned for those. And again, if you want to learn more about the New Hampshire Multifamily Fund, link is in the show notes to our deal room where you can download the deck, the PPM, watch our webinar recording, all that fun stuff. Be sure to go and check it out. We're really excited about this fund in general and how it's been performing so far. So go take a look if you are interested in potentially passively investing. For all the legal folks out there, that's a 506c syndication where we are only accepting accredited investors, which is why I'm able to talk about it on the podcast. But thanks again for listening to the show, and I'll catch you guys on the next episode.